Welcome to Banking Transformed, the top podcast in retail banking. I'm your host, Jim Marous. As we stand at the brink of 2024, it's important to unravel the seismic shifts poised to redefine the industry over the next year and beyond. Digital disruption, shifting consumer behaviors, emerging technologies, and evolving regulations are combining to completely reshape the industry at dizzying speeds. I'm joined in the Banking Transformed podcast by Brett King, a friend and a trailblazer whose foresight has continually heralded the next wave of financial innovation. Together, we dissect the advancements and upheavals that will reshape the banking world in 2024 and also peer into the future, envisioning what banking may look like as we approach the dawn of 2030. More than ever, bankers must understand these trends and harness the opportunities ahead in order to be able to thrive as we look at the future. As I often say, change has never happened this fast and will never happen this slowly again. In just the next year, we expect to see rapid developments from open banking adoption to new AI applications. Looking out to 2030, the landscape may be almost unrecognizable compared to today. And there's no better person to talk to about the future as it may be in banking than Brett King. You know, Brett, you've been such an astute voice predicting the future of finance. What emerging technologies like AI and automation do you see having the biggest impact on reshaping retail banking over the next 5 years?
Oh, wow. Well, you know, all the technology that's coming into the space right now, AI is going to disrupt not just banking, of course, but, you know, a ton of industries and, you know, disrupt our way of life in many ways, you know, for the better in most cases. But, you know, there's some new paradigms, you know, that we're going to have to adjust to. But AI, you know, I've talked about the technological impact on banking, and I have a series of books I've written on that. So, you know, I talk about Bank 1.0 being the traditional era, Bank 2 being the self-service era, where we extended branch operations to ATM machines, call centers, and then eventually, you know, basic internet banking. Then the Bank 3 era, which is, you know, the era most banks are in today, which is where we have mobile app-based banking. And this produced a sort of whole suite of new startups in the space, fintechs that we call them today, that have gained massive market share. You know, we just saw, you know, Wise's results this week, which are very impressive. You know, and then the Bank 4 era, where we're going into right now, is the era of embedded banking. Yeah. And so buy now, pay later and things like that are examples of that. But so is the fact that more people use a mobile wallet today to bank than they do a traditional bank account, which is something that's happened almost, you know, without the banking industry even noticing. You know, and then the fifth era, which I haven't really talked about broadly in the market yet, is Bank 5.0 is AI-based banking. And so to illustrate that, you know, and that's a trajectory we're on. So Bank 5.0 is sort of around the 2050 era, but it's starting now, right? And so to illustrate, JP Morgan Chase, you know, today it has 180,000 employees globally. So what does JP Morgan Chase look like as a Bank 5.0? Maybe 2,000 employees, and the rest is AI. Right.
And so that's bigger.
Right. Yeah. Right. And so that's the trajectory we're on. And, you know, so you've now got the consumer experience stuff happening, and AI is going to be part of that, the personal AI. And then we have the era of this truly smart bank account where your AI helps you manage your money. And then we have the era of the bank as an algorithm, you know, or a set of algorithms.
You know, it's interesting because in the past, you know, I've been in banking for 40 years now, but in the past, you know, consumers pretty much accepted what banks provided them. You know, the banking industry didn't move very fast, but neither did the consumer. They took care of trust. They took care of branding, all those elements. But we've seen major shifts in what consumers expect today. And it's because of not just what's happening in banking, but what's happened outside banking.
Of course,
And the gap has really got to the point where the consumers are actually ahead of where the banking industry is, where regulation is, and where everything else is playing catch up. I'm wondering, how big is the gap between consumer expectations and current bank capabilities in the legacy banking sector?
Well, if a bank asks you to sign a piece of paper ever, that's the biggest example of that expectation gap, you know? And so, you still have that embedded in a lot of banking practices. There's still the expectation, from many banks, particularly in places like the United States, where, well, if you want a real banker, you have to go and speak to them face to face and, find a parking spot at the branch and sign a piece of paper. And banks that rely on that type of activity are, obviously been shrinking fairly, I guess at a fair clip over the last few years. So that's the immediate thing, is that as a customer, I want to make it as easy as possible for you to execute on what you need to do. And the more friction I put in the way of you, then the harder it is for me to retain you, to keep engaging with you, and so forth. So I don't call KYC know your customer.
Yeah.
When it comes to the paper, I call it kill your customer, right?
Oh, you're exactly
those practices,
right.
Yeah. And then if you look at the other overarching expectation, it's informational. And that comes from lots of areas in our life, right? And I should be able to know exactly how much money I have, whether I'm spending it well, all of those sorts of things, those feedback loops around how I'm using my money. And so mobile wallets do a far better job of this than traditional banking apps. So categorization, showing you predictive cash flow analytics, all of those sorts of things. These are some of the features we see in these wallets. And, lending as a result is changing. It's shifting towards wallets in these markets, or, the super apps, and so forth. So in China, 40% of SME lending now is on the Alipay platform, and that's a massive shift.
Yeah, and it's interesting because we talked about it actually yesterday on a podcast that you hosted. That the reality is that one of the many things are holding the financial institutions back. A lot of it is legacy thinking, but even legacy processes. Like we talked about the difference between managing risks versus actually avoiding risks. And most financial institutions in the United States and many parts of the modern banking world still try to avoid risk, which makes it so you have a limited customer base you can serve, while, as you mentioned, in China, you have organizations like WeBank can serve virtually everybody, because what they use as their way of deciding whether or not to serve a customer is their transactions on their mobile device. They can manage to say who's going to go bad, which is all they try to avoid, as opposed to how good is a customer going to be. And through the masses, they can make it work. And, when you look at it, you look at generative AI and AI in general, it really is making a lot of things more possible. How do you see, as you're going around the world, how do you see organizations really changing the way they do banking based on generative AI or just AI in general right now?
You mean banks, or you mean...
Banks, yeah.
Okay. Yeah. Well, I mean, on the generative AI stuff, I think... there is not yet a really good example of generative AI in banking. And I'll tell you why. Is when we talk about generative AI and we're talking about, ChatGPT, Midjourney, DALL-E, these sorts of programs, you have these massive data models which enables you to extract various types of either language or art or whatever the case may be that's generated based on this AI's broad data experience. So the equivalent of that in financial services would have to be the most obvious area, is some sort of radical personalization of your banking experience, which would combine advice and would combine the ability to give you access to core utility of banking in a very highly or hyper-personalized manner. And so really no one is doing that today. We are starting to see elements of artificial intelligence and data science creep into the space, but there's no one that's really cracked generative AI. And I think part of that problem is that you have to be embedded in the customer's life from a technology perspective in a fairly complete manner. So the only I guess, architecture we have for that today is a mobile wallet on a smartphone. You do have voice-based smart speakers and things like that, which could obviously be an angle for that same AI. But imagine talking to your smart wallet, in your phone and saying, "Hey, how much money have I got? Can I afford to go out with my friends, to the football game on the weekend? Can I afford to go out for dinner on the weekend? What's my available budget given my goals of saving up for a new car or saving up for a house deposit next year, or whatever the case may be?" And your wallet would be smart enough to answer that question, or your wallet would be smart enough to give you, say, "Hey, looks like next month you've got a car insurance payment coming up, and you may not be able to hit that because of your current cash flow. This is what you can do about it." So it really has to be integrated into your life in a way that banks, I'm not sure, could ever really do. So that's really the gap there.
Why can't they, Brett? Because
Sure.
When I look at this, the data's there.
Yeah.
The view of the future is there, but it seems like financial institutions hold back from sharing it. I mean, Mint's being integrated into another platform, but when you look at just what a financial institution can do within their four walls, I'm not getting very much predictive ideas of what I should do in my banking from my current institution that owns enough information to do
look,
that.
banks could do components of this, no problem, right?
Yeah.
And banks could own this part of it if they're integrated with the wallet ecosystem like Apple Pay, Google Pay, and so forth, right? Because it's not, it's a behavior, it's largely behavioral. And so we do have financial behavior in a transactional level, but we don't have all of the other behavioral data that you'd need to give that. So we don't have geolocation data. We don't have, various psychological or behavioral triggers that sit outside of the banking system. So yeah, we do have a ton of data, but it would need to be married with something else. So this is why I talk about the ecosystem of banking experiences no longer being driven by banks. Yeah, you have the surviving banks as a component of that, but you now have the tech giants, the fintechs, and the AI players who are equally as important in providing those seamless banking experiences of the future. So banks have to be integrated into that environment, and banks still think in terms of primary financial institution and you coming to the bank as a customer to ask for a product from the bank. And that is the fundamental shift that occurs with this move to embedded banking through the tech layer.
Talk about embedded banking. How will open banking trends like embedded banking and composable technologies change where and how consumers interact with financial institutions in the short term? And let's say in the next 2 to 3 years. How do you see this all changing?
So I was talking with a challenger bank in fact, we hosted them on Breaking Banks, but a company called Weo, a challenger bank out of the UAE, Dubai, and they've got this new feature, Credit Plus, they call, which basically they can send you a message and say, like as you walk in a grocery store and say, "Hey, it looks like you don't have enough money for your groceries today. Do you want to switch into credit mode?" And so you can basically switch over your wallet from your debit card to your credit mode in real time. Yeah. That's an example of where if you are still thinking about banking, like provision of credit, like a credit card as a bank, then you're going to lose out in that scenario because that's all data decisioning. Right. So that's an example of something today. An example I gave in Bank 4, the book that came out in 2018, was mortgage shopping. And so how does a bank today know if you are going to buy a home or you're interested in buying a home? How it is that, you come and ask for a mortgage, and that's the first the bank knows of your intent to buy a home. Right. But Google, Apple, potentially Facebook and others, they already know you have the intent to buy a home. You've done Google searches on it. Apple, you've downloaded a real estate app on your phone. So they're they have a massive informational advantage when it comes to a home financing offer, because as you walk into a listed property, a property for sale, it's a fairly safe assumption, given your search history and behavior in the past, that you're actually looking for home financing. So now I can give you that offer contextually on your phone with a notification as you walk into the listed real estate property. Or if you walk into a Tesla dealership or something like that, the same applies, saying, this is how much you can afford. And at that point, why would you go to your bank and ask for a mortgage? Right. And jump through those hoops, because now you have, but the technology players are sort of acting as a gateway in terms of that, based on their data and informational, advantages.
It's interesting because we already have that data around auto purchase, because basically when you do a test drive at any dealership, they do a ping on your credit bureau to make sure that you'll be able to buy what you're driving. That doesn't show up on a credit bureau, but that data is available. And in fact, if you do a test drive, that's why we get all these ads from dealers and manufacturers around cars. Yet for the most part, financial institutions don't take advantage of that same data to offer something on a proactive basis. What holds financial institutions back from using the data that is available to be my GPS of financial service? What's your perspective on that?
Well, there's two major issues. It's rarely technological. Yeah. It's mostly cultural.
Yep.
And it's mostly reinforcing the existing product silos through the organization structure. So here, for example, if I'm going to offer an alternative credit product, which is a real-time credit experience, such as the grocery experience I talked about, immediately, if you're in a major bank that issues credit cards, the credit card team is going to say, no, you can't do that, because that's cannibalizing our credit card business. Right. So that's the problem you get, is that you sort of have this reinforcement of the existing product structures and org chart, because that's the way budget flows throughout the organization. Breaking that is extraordinarily difficult. It's rarely a technological issue.
Yeah, it's interesting because we talk about, I try to talk about the fact that buying technology will not get you out of the hole if your leadership doesn't envision what the future is going to bring. I mean, it sounds logical, but we play it every day. It's why both of us are in business to a degree, is that banking runs slower than we think it should. When we're talking about speed overall, how do you see the role of speed within the ability to compete and drive digital experience excellence? I mean, you see both traditional and non-traditional financial institutions. You see financial institutions in the U.S. and abroad. We continue, even real-time payments. We kid about the payments industry in the United States, but we don't see all the financial institutions, even all the big financial institutions, embracing and pushing real-time payments. This has got to be more than culture, doesn't it? Or is it still just culture that gets in the way?
The US is sort of a unique market in that it's a very protectionist market for the oligopolies that sort of run the different industries, and they get to write the rules, the regulations in respect to industry. So banking lobbyists are basically writing the rules about fintech adoption and crypto, and you can see that in the US because we don't have a fintech charter. We're the only country in the G20 that doesn't have a fintech license for a bank. And that restricts very heavily the ability for challenger banks in the US to compete, because you can't get a license unless you go the full license route. And incidentally, you have to have at least a single branch, right? Which no digital banking structure anywhere in the world has that requirement. For what's happened with the SEC going after crypto, again, that is the fact that the regulations are being written to support the existing Wall Street firms and investment strategies, rather than allowing this opening up. So that's the biggest problem in the US. But you also have legacy behavior. So let's look at checks, for example. Checks are still used, although they're in constant decline and have been for 20 years. Yeah. Checks are still used quite broadly in the US for things like payroll. And there's not an imperative for banks to incentivize people away from that system as yet, because they still have a lot of reliance on people coming in and getting a checking account, opening a checking account and so forth. So it needs to be a bit of a cultural shift there. I'm increasingly frustrated by the lack of real-time payments and so forth that's here, in the US market, because you can go anywhere else in the world essentially and use your phone to pay at least in developed economies, and developing economies as well. You can go anywhere in the world and just use your phone to send someone some cash, and it happens, seamlessly.
Well, it's interesting because the consumer, in many cases, feels like they do have real-time payments. Venmo and things like this give the
right.
visual of having real-time payments, and it's not really there.
There are workarounds, right? These
exactly.
are commercially available workarounds that work around the existing banking system restrictions, right? But it's not a standard. Where the US has said, we're going to have real-time payments, we're mandating it, we're going to make it as cheap as possible for banks to make that switch, and we are going to do these things to phase out checks and other, and the ACH, payments methodologies, because those legacy systems aren't helping consumers, they're increasing fraud, et cetera, right?
So, Brett, we've seen a lot of dynamics with regard to regulation. How do you see the regulatory environment changing over the next few years when we're looking at things like data privacy, when we're looking at AI and the risks and bias, and when we're looking at CRA, which is interesting when I talk about what's going on there. We visited the White House in 2013, 14, a long time ago. And we talked about CRA, and they just came out with a new regulatory decision on CRA, which looks more adequate than it did before. Do you see regulation as being a possible inhibitor to innovation within the United States, but even globally? Or do you see it possibly improving the innovation process?
Great question. So, let's take CRA. The CRA law was written in 1977. At the time, Star Wars was the number one movie.
My first year in banking.
Yep. And Staying Alive was the number one album. And our view of financial inclusion was that if you wanted to increase access to credit, the only mechanism available to do that was branches. And that got put into law, meaning that if a bank was the last bank in a town that served a certain population of people, they couldn't remove that branch because there was a social expectation as to financial access in that city or town. And so we have a large portion of regulation today concerning digital banking is framed in respect to the CRA, in that, well, if we create a digital banking license that doesn't require a branch, those banks that have a digital license are no longer subject to the CRA. So that's not a level playing field for the banks that are already in the United States. But if you step back from that and say, if you were to think about financial inclusion in the United States today, and it's still a problem because over 20% of households in the US are financially excluded. If you were to think about financial inclusion and solving that problem today, is the CRA the answer to that? And the answer is absolutely not. The answer is mobile, right? Yep. We've had more financial inclusion globally out of mobile than we've ever had from bank branches, right? We've had the fastest ever growth in financial inclusion as a result of mobile phones. So, you would have to say, if the purpose of the banking system is to include as many Americans as possible, then you need CRA reform. You also need to accommodate these digital pure play mechanisms, to enable, innovation in financial inclusion to occur. So we don't have that either. The things like real-time payments and the fact that in markets like, for example, China or Latin America or, India and across Africa, the wallet enables now a lot of those elements: mobile money in Africa, Paytm in India, Gcash, Paymaya in the Philippines, et cetera, right? And so that is, the US has all the data we need to know that this is a solution set that's readily available, but it requires an act of Congress. And that's, as we know in the current political environment, going to be very difficult, particularly when you've got the bank lobbyists saying, don't get rid of CRA because that's going to be an unlevel playing field, right? So I think, there's definitely a regulatory issue here. But on the broader sense, in terms of innovation, the US still has incredible resources financially to put into innovation generally through Silicon Valley, the venture capital arms, and so forth. So we will probably see efforts from players like Apple Pay and others, and potentially ChatGPT integration into the banking system as an effort to circumvent a lot of those limitations. But you also asked about identity.
Yeah.
So what we know today, and it might shock your listeners, particularly if they're in the US banking system, is today if you use your US-based credit card online in the US to purchase something, you have a 10,000 times higher chance of fraud than a person in China purchasing online using Alipay. I mean, it's just, and I'll give you the hard numbers because people say, oh, that's not right. Well, that's communism. 0.0006 basis points of fraud at 500,000 transactions per second for Alipay. Visa and MasterCard combined globally can do about 50,000 transactions per second, maybe a little more. And the card not present fraud rate is 11.2 basis points of fraud in the United States. Right. So those are the hard numbers. So this is a twofold problem. Primarily it's identity. Is that your 16-digit card number, your CVC, and the expiry date, these data points are no longer securable.
Right.
And so we have to, we can tokenize, but that is a stopgap measure. What we really need is digital identity infrastructure. We need biometrics. We need biometric heuristics. And this is where China, with the facial recognition and so forth, has, been able to radically reduce fraud on the mobile payments rails. And of course, that becomes complicated because we talk about now, oh, you're going to have a Chinese system, or, what about civil rights and so forth? Let's put aside that immigration and border patrol already have facial recognition for passports, and it's integrated. There are 600 federal databases already that use facial recognition. So let's not fool ourselves into thinking we're not using this tech. But at the same time, in a 21st century ecosystem, think about the pandemic. If you want to get access to telehealth, you want to get access to teleeducation services for your children. You want to get access to, ongoing financial services in the world of the future. It's always going to be based on digital identity.
Right.
You can't have all of this digital layer of services and keep paper-based identity documents, so or plastic-based, driver's license or a passport.
Right.
You have to have digital identity infrastructure. So I would say that if you start talking about AI now, if you're going to have an AI agent act on your behalf, the ability to tag digital identity deeply to you and to your IA, creating a separate digital identity for your IA that is your agent, that's part of the infrastructure we're going to need to keep these ecosystems safe. And that requires broad federal agreement. On identity standards and so forth, which I think we're a long way off from. So, unfortunately, if you're in America, you are having to absorb significantly higher risk and fraud rates because of the legacy regulation and legacy, banking infrastructure.
So you've talked a little bit about the competitors, about the fintechs and big techs. What competitors or models pose the biggest threat to incumbent banks? And alternatively, what types of fintech partnerships and collaborations do you see happening in the next year and then in the future?
Well, I mean, in terms of collaboration, we do have more and more fintechs partnering with banks, particularly on the infrastructure side, and with AI, I wouldn't necessarily say fintech collaboration, but AI, startup collaboration with banks is obviously going to be a big thing. You're also going to see banks acquiring fintechs acquiring banks, sort of this cross-pollination to some extent. In specific areas where there are specific capabilities that you want to get, like if you want to do buy now, pay later, rather than completely reinventing the wheel there. You might, integrate with a partner on that front. On the wallet side, you're not going to build a competing wallet to compete with Apple Pay. You really have to be integrated with Apple. So there are plenty of, tech and fintech type collaborations that are necessary for you to be present and connected to customers in the digital sphere. And, that's even before we start talking about central bank digital currencies or the metaverse or, AI-based agency and so forth.
Brett, can you expand a little bit around the idea of responsible banking and the importance of this in this current climate and how much we have from the standpoint of financial institutions walking the walk as opposed to just talking the talk?
Well, first of all, we're both the OGs, dude. So I'll state that.
Yeah.
But we are good friends. So,
yes.
And we've maintained that, I remember the early days getting you on hosting Breaking Banks and stuff like that. We've done a lot of stuff together. It's
fantastic. I wouldn't have this podcast today if it wasn't for you. So thank you.
I thank you for saying so. In terms of responsible banking, I would start with a very basic premise, which is, what is the main thing a bank should do for you, particularly as a customer, but the same is true of a business? What's the number one thing a bank should do for you as a customer? And I would argue philosophically, not from a regulatory perspective, is that the bank should help you save and manage your money.
Yep.
And we lost sight of that a long time ago in the banking system globally. If you look, since the 1970s, since the emergence of credit cards, there was an epiphany that credit access was where the money was to be made for, especially in retail banking. So pushing people to spend more money so they could increase their credit utilization is a fairly common aspect of banks. So we have cashback rewards for using a credit card. We have airline miles and airline benefits for using a credit card, and so we are increasingly have this posture where spend is the approach that we push from a product and revenue perspective as a bank, when actually it should be exactly the opposite for a consumer, which is we should just help you save money.
Yep.
We should help you manage your money. And so this is what I would say is AI's biggest contribution, is that it's creating the smart bank account. It is creating a bank account that will help you manage your money, and your AI will be on your side, right? Your AI will be saying, don't use your credit card. Don't use credit. You don't need to. These are the other options available to you. And that, I think, as at a basic element, helping you manage your cash flow, helping you understand your goals and how micro decisions, like how many times you go and buy a Starbucks coffee every week, how those sorts of things are affecting your overall financial health and sort of managing that. Now, the problem of a smart bank account that really helps you manage your money in that way for banks is it destroys all of their current product suite. It destroys their current revenue model. And for many banks, that will immediately make most of their retail banking customers unprofitable from a conventional viewpoint. And so you will see many banks who, have to make this shift, eliminating all but the most high net worth customers because of the margin, and a lot of the lower to middle income, customers shifting to rails like wallet systems and so forth. So that's my guess, right?
Yeah.
Is that there is that sort of, banks need to have that cultural shift that your bank account needs to help you save money. And to do so, it means a complete rethink of the product model and the revenue model in the bank. It's pretty significant shift, right?
Well, yeah, the shift actually gets more towards the investment model where you pay for a value transfer of showing empathy and providing value to me. I will pay for a financial institution's knowledge into how to manage my money better based on what they've learned about me in the past and what they know about me in the future. And we pay $140 a year for Amazon. And yet I'd be hard pressed for anybody to say what they really get over and above what a non-prime customer gets. But the reality is nobody gets rid of it. And it's because there's trust. There's an empathy feel from the Amazon team. There's the feeling like you've gotten to know me, and I trust the fact that you're managing my data well, which financial institutions have lost that. And it's no longer I want to work with the bank that's closest to me, because right now it doesn't matter where that financial institution is located, but I really do want to work with a financial institution that seems to be looking out for my well-being or building products that I really need. And I don't care if they charge for them if I'm getting a value back that's greater than the cost. When you look at overall digital transformation and when you look at the human element, everything else, what excites you about what can happen in the future of banking today?
Well, it's obviously a very big open question, but if we sort of limit it to the next 5 years, the reality is we're already starting to see some of this occurring. Look at Latin America. Nubank is now the largest bank in Latin America.
Yeah.
85, 90 million customers.
In a matter of less than a handful of years. Yeah. It's amazing.
Yeah, 8 years. 8 years. Yep. And then we bank in Shenzhen.
Yeah.
Again, 9 years. They first account was opened April 2015. So 8 years. Yep. But they obviously started the tech earlier. 380 million, probably 400 million customers by now. So if you want to look at all of the fastest growing financial institutions in the world, they're all digital.
Yeah.
So that means in 5 years' time, we've seen significant market share. Look at Wise, and all of the dominance that they have in terms of the cross-border transfers, and remittance market, out of Europe in particular. So market share is already changing around these organizations. So I think in 5 years' time, you are seeing lots of different organizations giving people choice in terms of what we would traditionally call banking that aren't banks, right? That aren't traditional banks. They don't have a traditional core system. They haven't gone the traditional charter route. They may eventually for regulatory reasons or growth reasons. But what is a bank has been radically changed. And I think this just gets weirder and weirder as the future goes on, because you may have an AI bank launch in sometime in the next 10 or 15 years, as an example, that, how do you license a fully artificial intelligence bank? How do you regulate that?
Yeah.
Like, we don't even have the start of the regulatory standards that might be required to regulate an algorithm as a bank that has a banking license. How do you give an algorithm a banking license? Well, you still have to have a corporation, and you need capital adequacy and all of those regular things. But a lot of those metrics that we had in the past, which was critical to create a healthy bank, actually the biggest benefit and the biggest risk is now this algorithm itself. So, this requires regulators to have highly technical understanding and capabilities. It actually requires regulators to be tech organizations themselves, which, we're clearly not in that situation as yet. So, in answer to your question, I see that the traditional banking infrastructure, including the regulation, continues to get attacked mercilessly by these emergent properties and these emergent models. And the markets that best adapt to this in terms of their regulation, in terms of their openness and their ability to absorb experimental models and things like that, are those that, mature as an economy fastest and in the most productive manner. So, at a macro basis, we're moving from, a situation with highly bureaucratic government systems and lots of these old paper-based systems that have been retrofitted onto computers and things like that, to autonomous government, autonomous markets, what I would call smart economies of the future, which are highly automated. Mm-hmm. And the largest economies of the 2050s are going to be highly autonomous economies. So the more resistance there is to that autonomy and that high level of automation, which, it is a way to keep government big, then you have significant problems in terms of decade-long development as an economy itself. It makes it much harder to compete. It also makes resource utilization and all of those things much more difficult to manage moving forward. So you retain a level of complexity in the system that you just don't need moving forward. That's the key issue, right?
So what emerging technology that's currently under the radar do you see that could be transformative as we get towards 2030, let's say?
I think there's a few philosophical changes happening in the 2030s. I do think that you're going to start to see a lot more smart contract activity. So smart contracts are the AI-based components by which we run business, commerce, and marketplaces in the future. So you know how it happens today. You have you have your company, you have vendors, or suppliers, and you have clients. And right now today, those relationships are defined by a contractual arrangement. Sometimes it's a very simple contractual arrangement. You just go and buy some stuff off their store, right? Sometimes it's more complex, such as distributorship agreements and so forth, right? Real partnerships. But that starts to get implemented in code. The rules by which you get paid, and as many elements as we can for automation in that. So maybe autonomous delivery of packages and things like that, or ordering that's done and managed by an algorithm or two algorithms talking together. Those sort of things are managed by smart contracts. And there's no bank in the US that I'm aware of right now that has smart contract infrastructure. Maybe JP Morgan Chase with some of the work they've done on tokenization and so forth. So it may not be fair to say no bank has it. But,
but it is emerging elsewhere. I mean, IBM's starting to put things in place, and others.
Right.
Yeah. So
that's a primary element we're going to be experimenting with to create sort of dynamic autonomous business operations and so forth. That has implications because US dollars don't really work on smart contracts the way a central bank digital currency does, because if I send your US dollars out with an AI-based agent, it's gone forever.
Right.
Whereas with a central bank digital currency, if an AI agent makes a mistake, you can roll it back as long as both parties agree, as an example, right? You've got that traceability and auditability and so forth that you have. By the time we create enough smart infrastructure around the US dollar to make it work like a CBDC, it is a CBDC. Right. So, a lot of people saying we don't want the CBDC in the US because it enables tracking and, and control over bank accounts and so forth. Well, at some point, the US has to decide, does it want to be the world's leading economy and use automation to keep that status? Or are they going to let, that moniker of being the world's largest economy go to someone like China because of their automation?
So, 2030 at one point seems a long way away, but on the other hand, it's very close. Do you see the way we do banking changing between now and 2030, where maybe we're not doing it on a phone, we maybe are doing it on another device or another way, or there's some new technology that's being introduced right now?
Sure.
Probably
the most obvious one will be, rapid improvements in voice interaction.
Yeah.
With your bank account, so you'll be able to just tell your bank account what you need to do.
Yeah.
Like, for example, oh hey, bank account, can you check if I paid my car loan payment this month or something like that?
Yep.
Those types of interactions. That's probably the most obvious area over the next few years. But the other area is all of the fastest growing FIs, again, are those that are digitally enabled, digital acquisition. So here's the thing is by 2030, you're going to see quite a market share shift in the US, where the biggest banks are those that are really digitally competent, and those that haven't made that switch. If you are still requiring a signature on a piece of paper in 2030, you are going
or a driver's license.
Right. Your business is going to has shrunk to half its size of today potentially.
Yeah.
Branches in sometime around 2027. branches will hit half of the peak in the United States. In the UK, it's far less than that. They're down to about a quarter of the branches that they once had. That trend, there is nothing that we see in the future to reverse that trend.
Right.
So again, if you're a bank that's relying on a customer coming into a branch, a lot of that market share is going to shift away to banks that can onboard customers digitally. And we saw that happening during the pandemic.
As we talked about yesterday on your podcast, it already is. It's just that banks haven't recognized it. You know, it's right. The silent attrition is upon us now. It's just really interesting. You know, Brett, you're a voracious writer. You're writing all the time. You're on the road all the time, also visiting organizations across the world. What are you writing right now? What are you working on?
Well, we're working on a project together.
Yes, we are.
So it's called Branch Today, Gone Tomorrow. Hopefully this will be out in the first or second quarter of next year. And it is really a definitive look at branch utilization globally, at looking at, a dozen or more economies and seeing the way branch utilization and branch traffic has changed. And really helping people understand that the era of the branch as the primary channel for banking is over. And we know this because in 2013, the density of branches globally started to decline, according to World Bank data. Yep. And we know that from looking at all of the major markets, that the number of branches globally started to decline around 2017. For the first time in 500 years. So this shift in posture means that banks have to have that mindset shift, that if you are still going to have branches, and regulators need this shift as well, but if you are still going to maintain branches, their primary role moving forward is to support digital. You can't think of them as, you can't think of them as the primary channel and digital as secondary, because all of the fastest growth is coming from digital. And so the more you rely on branches in that scenario, the less growth you have, the more market share you give up to competitors who are digital. So you have to really say, all right, well, how is branch is going to work to support digital? And there are good opportunities for that. You know, the Genius Bar concept, you know, the more technical help. I often say in 5 years' time, if you go into a branch, probably the number one reason you have to go into a branch in 5 years is your tech isn't working.
Yeah.
Can you help me fix my app?
Yep.
You know, I can't send, I can't use my wallet with the card in the app for some reason, whatever the case may be. So again, this requires a different level of thinking about the skills and resources in branch, and, even the size of the branch. Telewindow becomes far less important than just having someone with presence, with a iPad or something like that to help you. So that's sort of the example of what's happening in Branch Today, Gone Tomorrow. I'm also working on a science fiction series.
Wow.
Which I don't want to talk too much about yet, but get some really interesting moves in that respect. And the next book I'll do next year that I've sort of started working at is, because, you and I both have extraordinary access to the fintech OGs.
Yeah.
Is I wanted to tell the story of the emergence of chenallenger banking around the world. David Valles from Nubank, Tom Blomfield at Monzo, and from Starling, Henry Marr at WeBank, and basically
Brett King from Moving,
of course, and get these guys to tell us their story as founders. And so the working title of that book is The Rise of the Challengers. Right.
That's great.
And that includes also, the mobile wallet, structures and stuff like that. And that is, I really wanted to document that period of history where banking sort of really fundamentally changed, and the trailblazers that helped us through that process, because we do have that for Silicon Valley, in terms of the rise of Silicon Valley, and we do have disparate information about individual challenger banks and so forth, but no one's really put together a historical perspective on the rise of all these different challenger models and, what it will ultimately mean. So that's something that I'll be working on next year.
And wherever you are at the time, I know that sometimes we touch base in coffee shops globally, and it's you are, if nothing else, everywhere and anywhere. So.
Well, I am starting to rethink that a little bit in terms of, whether I need to slow down the travel a bit. I'm not recovering as quickly as I used to from the jet lag and stuff. Yeah, I'm sure you do. And so I am sort of rethinking that to some extent. But, having said that, I'm blessed to have really generated, a global audience and global demand as a thought leader. I do a lot of work with central banks around the world now, sort of helping them. I'm on the boards of some new fintechs and startups around the world. I spent a lot of time, in the last 5 years, including during the pandemic, I've done 60 countries or so where I've toured and been able to talk about what's happening in this space. But there needs to be antagonists. We need people like you and I out there helping the traditional players see the rate of change and what's happening, so they at least have enough warning to be able to adapt and make the changes they need. As we've seen in many other industries, publications with Amazon and Kindle versus the bookstore, and Blockbuster versus Netflix and so forth. Rarely do incumbent organizations survive this transition. It normally is new entrants, and the same is happening in banking. We can see today that the world's #1 bank account is a mobile wallet. It's not a debit card issued from a bank branch. That's already happened, right? But the banks still think like, well, we've got all this money, we're still making all this profit, so we must be doing it right. Right. But in many ways, the pendulum has already shifted.
Brett, thank you as always. It's been a while since we've been on the show together.
That's great,
I'm really glad to have you on the show and keep up to date on what you're doing. Safe travels and have good holidays as they're coming up.
Thank you, brother.
Thanks. Thanks for listening to Banking Transformed, the top podcast in retail banking and the winner of 3 international awards for podcast excellence. We appreciate the support we've received to make this endeavor a success. If you enjoy what we're doing, please take some time to show some love in the form of a review. Finally, be sure to catch my recent articles on the financial brand and check out the research we're doing for the Digital Banking Report. This has been a production of Evergreen Podcasts. A special thank you to our senior producer, Leah Haslage, audio engineer, Chris Sofalius, and video producer, Will Pritz. If you have not already done so, please remember to subscribe to Banking Transformed on both your favorite podcast apps and on the YouTube channel for more thought-provoking discussions on the intersection of finance, technology, and leadership. Until next time, remember, keep innovating and transforming.